Everyone, and welcome to our discussion today on this topic, which is revenue from contact with customers. In this particular section, we're going to talk about a scenario where, for example, a seller or an entity is, paying something back to the customer, right? It's not surprising to see that while you are selling some goods, you are also, giving something back to the customer, right? This could be in form of cash. This could be in form of, let's say, some, other goods. That is, in terms of a non-cash consideration as well. So what we need to understand is how do we differentiate between such compensation paid or any goods being offered back to the customer, and and how does it impact the recognition and measurement of revenue as well. Okay, so before we get into the context of the standard, the relevant paragraphs, let's try to understand what all can happen and why we said that it is so common to see these kind of things here. Put it like this: there is a company X, so this is a seller, and this is of course customer. Okay, now this company is, let's say, into hotels plus dining, and this is, let's say, a corporate client. It could be a retail client as well, does not matter, right? So what this company does, when this client visits for stay plus dining, this company offers coupons that may be redeemed in future. Okay, so the point is that when you look at consideration, the amount or the consideration that you're paying back to the customer may not necessarily be in form of cash. Okay, but then it may also happen that this company is able to, let's say, offer a free stay in future. Okay, right? I mean, let's say 4 days visit, 1 day free, or things like that, subject to, let's say, probably 2 days plus 1 day free, something of that sort. Right? So what you are looking at is, many a times you would come across situations when the customer is offered something back in form of a compensation, right? Another example I can think of is a cashback, right? Wherein we are saying that a telecom company has got a payments bank, right? If you make the payments through this bank, of course you first deposit and then pay for the telecom services. Okay, so what we are saying is this cashback becomes a kind of a consideration payable back to the customer, right? So we are going to talk about in terms of what is the standards, specific context in this regard, right? Just to give a brief idea, we are all saying that such consideration is deducted from the revenue, right? This is a thumb rule, of course with some exceptions, right? Let's even talk about those exceptions and then look at the precise context of this discussion here. Let us say that there is a company X and there is a company Y. Okay, so let's say this company deals into hotels. There could be obviously many more examples around that. Let's say that it's a computer manufacturing company. Okay, and this company Y is a dealer of or dealer in motherboards, right? Original equipment manufacturer. Okay, so it has a license through which it obviously is, manufacturing those motherboards and supplying to various clients, including company X. All right. Okay, so let us say that company X sells 100 computers to company Y at $500 per unit. Okay, but then company Y, in its capacity as a dealer in motherboard, is also selling these motherboards, I'll just written MBs here, at the rate of maybe 200 per unit, right? Now obviously in a usual business transaction, your customer can be your supplier as well, as we see in these cases. Y is a supplier for X, X is a supplier for Y, so they both meet each other's requirements, right? So in this case, what we say, normally the purchase from company Y is not adjusted from sales to company Y, and it should not be, of course, because it is, these kind of transactions are done in a very independent manner, in a capacity of a seller and the capacity of a buyer. That's it, right? But then think about it like this: the price at which X is selling or Y is selling the goods to X is $200, but the fair value is, let us say, only $150 per unit, right? Now this raises the eyebrows, that Y is selling these kind of goods to other companies at 150, but it is selling, of course, something to company X at 200. Why it would want to do that? Probably this pricing is also inflated. The way this pricing is inflated, right? This pricing is also assumed to be inflated to the extent of the difference between the fair value of the goods or services provided against the price being charged, right? Look at the impact. Revenue is increased. Revenue is increased here as well. A clear violation of accounting principles. You're just grossing up the amount, right? And this is one easy way, or a mechanized way, or a manipulative way to do the same. Okay, so in such cases, of course, the standard says that this difference shall be adjusted from the revenue, right? So the whole context of this consideration payable to the customer would ask a very basic question: why are you paying him back? He is your customer, you are not exactly his customer. So if you're paying him something back, effectively you would have charged him something extra. There's a reason why you're paying it back, right? So when I look at my standards context, It simply discusses these principles and of course expects an entity to do the accounting accordingly, right? So what we have the context as consideration payable to a customer includes cash amounts that an entity pays. Of course, we are talking about the seller here, okay? Or expects to pay. So there may not only be an explicit, term or a clause, but it could be also an implied term or a clause. Or expects to pay to the customer or other parties that purchase goods or services from the entity, right? Not from the entity, but from the customer. So you're looking at somewhere either to the customer directly or indirectly through the customer. So you're just covering those areas as well, okay? So this may also include something in credit, okay? So we are looking at credit or other items. I mean, think about it like this. You buy a house from us and we'll give you a car, okay? Think about it like that. Buy a house from us, we'll give you a car. Buy 5 things, we'll give you something, extra. 5 plus 1, 2 plus 3, 1 plus 1, something like that, right? So what you need to really kind of see is that how are these terms, being measured. But then what we are further saying is on the 1 plus 1, 2 plus 5 kind of a concept, we might want to split the revenue there. But here we are saying that if there is a credit or other items given, we are saying that can be applied against the amount due to the entity, okay? So let's put it like this. I'm talking about a standardized scheme. Scheme is that house for, let's say, $100,000, car worth $10,000 free, okay? The difference between this and the above context is like this. Here we are talking about 2 things being sold at a price of $100,000 because this car is worth nil in terms of obviously being given or offered to the other party, the customer. But then what this standard is trying to say, what this paragraph is trying to say, you buy a house, pay $100,000, we will offer you a car that has a value of $10,000 and the amount worth the value of car can be adjusted against the amount due for the house. Okay, so here you are selling two things. Here you are effectively selling only one thing, which is the house, because the car is never offered to the customer from that perspective. So even if it is offered, if you provide this clause that adjust this against the amount due from due on that particular house, that is where this clause is expected to get adjusted against the revenue, right? But then let's say that if the clause specifically says that the car will be provided and not resold to the entity, right? Car will be provided and not resold to the entity, then most likely you're talking about splitting the consideration which is $100,000 between the value of house and that of the car. Okay, so one needs to be a bit more watchful when you look at these kind of adjustments here. All right, so that is something which is a relevant consideration for a business to make. All right, so what we are simply saying is, if this above thing happens, then the amount of the consideration payable to the customer shall be adjusted against the revenue recognized by the customer. Okay, are you fine with that? Okay, now here there is also a context of if there is a variable payment, right? Now variable payment is a big area within this standard. So I'm not bringing it here precisely. That is more to do with how should we look at a variable payments or variable considerations measurement first of all, right? I mean, think about it like this. I'm selling some goods to a customer, and on the basis of the goods he sells, I'm going to provide him some kind of incentives or commission or things like that. Normally in case of franchisee agreements, you look at these kind of instances. So let's not get into that at this point in time in terms of how should that be accounted for. We have a specific section to deal with that, so called as variable consideration. Okay, now we also said, what if you are buying some goods back from the customer? Okay, so what we are saying here is, any consideration payable to the customer for the distinct goods or services purchased from the customer, right, shall be considered as a normal purchase consideration like with other suppliers. So the way you buy goods from other suppliers, if you're buying it from customer, doesn't matter. He has his sale in the books, you have your sale in the books. He has his purchases in the books from the goods purchased from you. You have your purchases in the books for the goods purchased, by you from him. It does not make a difference. But then, what if the amount of consideration payable to the customer? So we are saying that if the amount of consideration payable to the customer exceeds the fair value of goods, the excess amount shall be deducted from the revenue from the customer. Quite straightforward. We have discussed the example already. Yep. Okay. Now let us say that it's a specific item being sold by the customer back to the entity. Okay. And the value of that item, the goods or the services cannot be measured reliably. Okay. So we are saying that if the fair value of goods or services procured from the customer cannot be reliably measured. Very conservative view, and rightly so. The entire consideration payable to customer is deducted from revenue from the customer. Right? Very clearly, very rightly, we are looking at this particular thing here. Okay. Now, the final thing. Let's say that we know that we need to make this adjustment, like in this case, or in this case, or in this case. Right? So let us say that if we need to make this reduction, the question is, when should we make this reduction? When should we say that revenue needs to be adjusted? Okay. So the standard says that, the standard provides adjusted at later of. Now this is very important here. Let's look at the significance of the timing of revenue. Later of, one, when the revenue is recognized on the transfer of the goods or services to the customer. This is something which is expected. And since we're talking about later off, the second point says that the entity pays or promises to pay the consideration even if it is conditional on a future event, right? The way we said, look at any coupons being offered. Okay, so when I look at it, you sell some goods worth $100, you get coupons worth $10. Okay, so we are simply saying when the revenue is recognized on the transfer of goods or the services, let's say this is done on 1st of January 2018. Okay, and then we are saying that when the entity pays or promises to pay the consideration. If I say that, there is a possibility that you can avail this until 1 month's time. Okay, so what you're looking at is, look at the later of the dates, look at the later period as to when should this transaction be adjusted for the purposes of, let's say, this particular revenue recognition, right? We certainly have more examples to discuss these things, but as of now we are sticking our discussions to the relevant context of the accounting standard, right? So something that you need to kind of take care of when you look at consideration payable to a customer by an entity, right? Specifically here we have done this discussion. Obviously the more lectures that would talk about the application of such kind of concepts in a more complicated scenarios. We'll try to obviously simplify that. That is something that we want to do as well in our series of these lectures, right? So something that we wanted to cover in this particular session today. That's it from my side, and thank you very much. Keep watching these videos. Do subscribe to our channel ABC Learning, and all the best. Good day. Take care.